financial health of the company at a B.
Our second pick was Urban Outfitters. Urban Outfitters owns Urban Outfitters, obviously, but also Anthropologie, Free People, and another brand called Terrain. Some of the key statistics: it closed yesterday at 15.21. Its beta is 1.4, which means it's a little bit more volatile than the industry, so it's a little bit more of a risky pick. Their price earnings was 9.94, which is a little bit lower than the industry average. The ROE and ROA are both above the industry average, which is a good indicator for them. The earnings per share is below the industry average, so you might want to look at that. The 52-week high is obviously much higher than the current price, but it is up from the 52-week low, which could mean that it's slowly coming back. Morningstar gives Urban Outfitters 4 stars. It rates its growth at a B, its profitability at a C, its financial health at an A, and the Yahoo mean recommendation is a 2.1. Though Urban Outfitters and its brands are a little bit more trendy, some of the analysts do believe that the store concept won't be as affected by the market as some of the more high-end trendy stores because the prices aren't as high. And then you can see the chart, which is pretty much the way everyone's stocks have been going. It's not a good time for apparel. Our third pick is Gap. It owns Piperlime, Banana Republic, Gap, and Old Navy. Today's open was $11.06, and its beta is just over 1, so it's a lot less risky than Urban Outfitters as it moves closer to the market. Its price earnings is 8.07, and the ROE and ROA again are higher than the industry average, but the earnings per share is lower. It is just above its 52-week low though, so it's not as good for Gap as it looked for Urban Outfitters, though a lot of the analysts believe that since Gap has had fairly poor performance in the past few years, they've been preparing for a slowdown for a while. So they might make it out in a little bit better condition because they know how to cut costs.